Hello, Jim here. I've been on a journey to learn the right way to sell options, and I had one of my better weeks last week. I want to share with you the strategies I use to have such a good week, and at the end of the video, I'm going to share my trades in detail. So stay tuned. I think you're going to really enjoy what I have for you. Let's go ahead and jump right in. I typically give a quick market update. I don't really have much to add this week. The early part of the week was down. Of course, the market was closed on Monday, Tuesday, and Wednesday. It was down. There was a lot of fear related to NVIDIA earnings, and they pretty much, again, shocked the world. They had really good earnings, and the market's way up today. So it's been this kind of crazy up and down, and I think that's going to continue. We are coming closer to the end of earnings season, so I do think things will level out. I also have started to wonder if we're going to get a cut in the rates this year. The economy's doing better than anyone expected. I'm not so sure we're going to get a rate cut. If we do, it may be third, fourth quarter. And the Fed has pretty much come out and said, yeah, with the fear of inflation and the fact that the economy is doing pretty well, there's no need to be cutting rates at this point. So I don't know. Of course, things could change pretty quickly, and maybe they will do a rate cut. But I'm beginning to wonder if we have one in the works. We may not. They may keep these rates up all year, and maybe into next year, depending on what happens. The one uncertainty with that is the fact that it's a presidential year. So who knows, maybe politics get involved and they do one rate cut this fall to really kind of, cause a little bit of a spur of the market at that time heading into the election. Who knows? Typically, election years are good years, so we'll see. I'm not betting on a rate cut. So let's jump into the main content. Now, this last week was one of my better weeks, and some of the reason for that is the fact that I have a pretty balanced strategy with trading, especially using options. I have plenty of covered calls. I have plenty of cash secured puts and vertical put credit spreads. I kind of balance it out, and which works out well. If the market's way up, then it's a good time to sell covered calls, and your puts become very profitable. So there's a nice balance. And then if the market goes down like it did earlier in the week, the reverse is true. It's a good time to sell puts. When people are fearful, it's a good time to find some good opportunities out there. And on the flip side, your covered calls may become very profitable. And you probably noticed I said covered calls. I typically don't do naked calls. The exception is if I'm doing something along the lines of an iron condor, which has spreads on both sides. And I typically take less risk on the call side compared to the put side. I typically don't do any other types of trades without it being covered, either cash covered or I already own the shares. I also wanted to mention, I look at it as an investing. So any of the stocks I look at, any of the ETFs I look at, I typically want to own them. The exception is IWM. I will do some trades when IWM is a good value. Currently, I think it may be over 200 now. I think it's a little bit on the pricier side. So I haven't done any trades recently on IWM. And that probably will continue until we get kind of a little bit more of a downturn in the market, unless something fundamentally changes. And I feel like IWM becomes another good opportunity. And I don't typically want to own IWM. I trade it like a lot of people trade SPY. I just like it because it's closer, with it being around 200, 190, it's a lot less expensive than dealing with SPY, which now is currently over 500. So I typically start from the standpoint of investing. Sometimes I feel like when new members come in or people ask me questions, it's almost like gambling, and you can definitely go down that route. You can take too much risk and turn it into a gamble versus an investment, that you're really taking the time and picking the right stocks, picking the right ETFs, and making good decisions with the investments that you make. When you purely just want to make income off it, you can run into some problems. And like I said, again, it becomes a lot more like gambling than investing. And I find it really important to have really good guidelines. And my guidelines keep changing. In the end of the video, I'll be sharing my planning worksheet. And in that worksheet, I have a sheet that talks about just the guidelines. And every month it seems to change some. I have slightly different guidelines for when you're dealing with ETFs. You can potentially take a little bit more risk with ETFs. With stocks, I prefer to take a little less risk. If I'm potentially running the wheel, when I have an account that is mostly cash, it's not overly invested, meaning I don't own a bunch of stocks or ETFs in it, then I'll run the wheel and I will take a little bit more risk with running the wheel than, if I have an account that has lots of stock and ETFs and I don't have a whole lot of cash, I'll typically do more vertical put credit spreads and take less risks. I'll do something along the lines of a 15 delta, which is like a 15% chance that, the stock will be at the strike price on expiration. So it's like an 85% probability that it won't get assigned to you. In a wheel strategy where you're selling the put, hopefully getting assigned, and that's your goal. You want to get assigned, and then selling a call and then getting assigned where you have the cash and kind of repeating the process. I'll take a little bit more risk. I'll do something along the lines of a 30, 35 delta. I've gone as high as 40 deltas depending on the price of the stock. If it seems like it's a bargain stock, then I'll typically take a little bit more risk. So if I'm doing a 35 delta, that's like a 65 chance that it'll be assigned to you. The probability is like a 65% chance. And I also wanted to reiterate, it's really slow and steady, especially with selling options. If you start panicking, a lot of times the brokers will show you, oh, this is a net loss of 30%. And you look at that 30% and wow, it's a net loss of 30%, but you forget, well, the strike price is still way off from the current price of the stock. So maybe the price of the stock is 30 and the strike price is 22. Even though it's showing as a loss, you're really pretty far away from it. And sometimes the loss percentage they'll show you, or the amount of the loss, is based on a calculation that they do. And if there's really high bids out there, it can kind of make it look like it's a bigger loss. So I encourage people, don't just look, is it a loss? Look at the strike and compare that strike to the current price of the stock and be patient. I've had many positions that have gone in the money, come back out of the money, gone back in the money. And I've even had, and I'll share at the end of the video, one particular stock that's been in the money for a long time, I think over a year, maybe a year and a half. And I've been rolling it, making good money on it as a covered call while it's been in the money. And that's worked out really well. So I really need to reiterate, you need to be patient, and always remember, like what Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. So in instances like what we're going through right now with NVIDIA, I think it's up over 100 points today. It's not necessarily a time to jump in. It's kind of like he says, people are being greedy, so you need to be a little bit fearful. You might even want to consider, if you own some NVIDIA, you're one of those fortunate people who own maybe a couple hundred shares, may want to look at buying some puts. The fact that it's gone up $100, you might be able to find some pretty inexpensive puts that, are maybe $20 or $30 below the current strike price that are next to nothing to buy, that protect you. So if something happens and it drops, 150 points next week or something, you're protected because you could always put it to someone. Plus that put would become worth a lot more too. So it's just something to kind of take into consideration. And again, with sticking to safe strategies, sticking to safe guidelines, you'll find your winning percentage will go up. I also encourage people to start slow, pick lower goals, and then grow those goals. My original goal was 1,000 a month. Now I'm doing something along the lines of 6,400 a month. Over the last 3 years, I've been slowly increasing that as I get more confident. But I don't start with a really high goal. I feel like if you start small and you have some wins, then you'll become a much better, confident trader. So That being said, let's jump into the next part of this video where I'll share with you my trades from last week and how I was able to earn over 2,000 during the week. So, and again, as always, if you want to learn about my memberships, there'll be details below. You can find me on Patreon at Easy Investing Income. I have two main membership levels. I have a coaching level. It's $25 a month. I think that's almost full. I only have a few spots, maybe 7 or 8 spots left with that. And then I have a main area that's $10 a month. You get my trades, you get my spreadsheets, you get my collections where I have group meetings. We do group meetings at the trader level, and then I share them with the investor level. And I think that's going to continue. I may make some changes to the tiers down the road, but right now I don't have any plans in the near future to do that. But maybe within a couple months, I may make some changes in the tiers, especially once that coaching tier fills completely up. So, take a look below. It'll be in the description, more details. So let's jump into the next part of the video. I've opened up my planning worksheet. This is the one not for this week, but for the previous week. And I release these every Sunday. And I typically will look out 3 weeks and look to see any positions that might be expiring in that 3-week period. And I typically add them to the spreadsheet so I can manage it. So this is what it looks like at the end of the week when I've done the trades and I've managed it. But at the beginning of the week, there's no color coding. I think it was the first 7 or 8. And actually, it was only the first 5 trades that were expiring, either 2/16 or 2/23. Everything else are new trades I've made or trades I've rolled. I also at the top, I share notes related to the different types of trades I do. So vertical put credit spreads, cash secured puts, the wheel, poor man's covered call, which I only have one poor man's covered call, which was done with Palantir. Also at the top, again, details about the particular planning worksheet, my weekly and monthly goals. And then this February premium, I also keep track of how much I've earned for the month. And this is just purely premium. This doesn't include dividends or anything else. And it's for the week. It will also include, any positions I close. I'll put them in this spreadsheet too. I believe I have one position that I closed. I don't know if it's in this spreadsheet or the previous one, but I do know I closed Cisco, which I think is up here. Yes, Cisco's here. That was at the very top. So the premium. You can see that's a -8. I paid $8 to close that position in Cisco, and then just noted that it's closed. I also note for each trade, and we'll go through them fairly quickly here. I note what account they're in. This is in the IRA Fidelity. I have all my retirement accounts at Fidelity. I have all my taxable accounts at Schwab. Mainly because I want to use Thinkorswim going forward. I still like the Schwab interface a little bit better than the Fidelity interface, but I do like the interest that I can earn in a true swap account at Fidelity. So on all my accounts, any cash I have dedicated to cash secured puts is earning interest right around 5%, a little bit more, a little bit less, depending on the week. So the first trade here, again, was Cisco, and I just closed it. These other trades I didn't do anything with. All of these were far outside the money. Google was a good $20 outside the money. And I've only recently started trading with Google. When it came down at one point, I think it got into the 130s, and that's when I did this 120, 110. I think it might have been like 135 or 138. IJR is an ETF that I really like, and it's also way outside the money. Currently, it's 106, and it was at 92. So being that this is a week later, it did expire outside the money. Palantir, this was a vertical put credit spread that I did with Palantir. It doesn't relate to the poor man's covered call, but I did a 16.6, and this was in the wheel, again, the IRA Fidelity, and I purchased the $6 put, the outer put, primarily because it was only $1 to purchase. Let's come over here. Well, I don't really have premium on that one since I didn't do anything with it. It also expired and was fairly profitable So next is the group of positions that I did do something. One, CF Industries, I believe it's a metal or minerals company. It's one I've been investing in a while, and it's been kind of treading along pretty close to being in the money. It'll go in the money and come back out of the money. And I rolled it. Originally, it was 73.65, expiring on 2/23, and I believe this is the second roll. It was 78.08 at the time, and I rolled it out to May 17th. It was having earnings, and this is supposed to be earnings and ex-dividend dates. These should be moved over one line. So I rolled it to 517. I went down a little bit in the strike, and I kept the outer strike at 65. So I thinned the spread a little bit. This is all the premium, so I have changed these worksheets a bit. So I show all the premium from previous trades. So 674 when you add the current premium. So the 674 includes the 197.87, the required capital, which is the spread, and I believe this is 2 contracts. So it's what is that? That's 750 times 2 minus the 197. And then the DTEs was 94 days. So when you plug that in and adjusted for the length of time that's left, or for a yearly basis, it was like a 59% return. So it worked out quite well. And I still have that today. I'll probably look at potentially either closing it or rolling it again. I wouldn't mind, like I said earlier in the video, I'm fine with owning any of these stocks. So I'd be fine with owning CF Industries. So CVS is another one. This is a new trade that I did on 212. A vertical put credit spread, 72.50, 62.50. Now, a lot of people ask, well, why do you pick a $10 spread? It's just what I like. And a lot of times what I'll do is I'll look at that 62.50, then I'll see, well, the 63 or 63.50, is it cheaper possibly, or is it a better price? Then I'll look at 64.50. And if I can find a cheaper price, like on the CF Industries, then I'll take that cheaper price. Or not really a cheaper price, a thinner spread. So I'd take the higher priced, so like a 64.50 if I could. But if I don't find where it really makes sense, then I stick with the original $10 spread. So the 72.50, 62.50. This was expiring on 5/17. So again, right around 90 days, I believe. Current price was 76.24. So about $4 near the money. And I brought it in $325. Again, this is in my Fidelity IRA account. And these are the same because again, this is a new trade. And this is pretty much 2,000 minus the 325.28. And then when you adjust it for the number of days, again, 95, it's like a 75% return. And CVS, again, is one of my favorite companies. I've done a lot of trades on CVS, but this is the first one in a little while that I've done. For some reason, I haven't found good premium up until recently. Same thing here with Apple. I recently did a vertical put credit spread on Apple, and again, this was last week. Apple came down a bit. This was in my Schwab SEP or SEP account. This is a retirement account related to my business. And I did a 165, 155 when Apple's was 183. I believe Apple's gone up. It may be closer to 190 again. So my guess is these will probably expire outside the money. I've done quite a few Apple trades over the years. Not as many recently because I felt like it got expensive. But I picked up 190, 140 was the premium. And again, the 2,000 minus 191, that's how I come up with the 1808, which is like a 41% return. So not as good as some of the others, but still pretty good. And I want to get back into the mix of trading Apple. I think it's one of the best companies out there. I know it's one of the best or best run companies out there. Now here's an ETF. I believe it's the only ETF for this week, SCHD, my favorite ETF. It primarily has dividend growing companies in its portfolio or holdings. So this is a roll. It's a covered call since I already own these and I had it at 75. I believe it got up to just today, I got just shy of 78. But I went a little farther out, so it was expiring on 4/19. I decided to roll it out and get it out of harm's way. So I rolled it out. This is a leap all the way out to 116.26 to $78, which again, it's still out of the money, but it's again getting close to it. And you might ask, well, why would I do that? Part of the reason is I do need a down payment, or I'm working on a down payment for a property. So I wanted to bring in a bit of extra money. So with the last trades recently, a total amount of premium that I've received over the last, I think, 6 months to a year is around 1,600, and that includes 553 that I took this time. And here's the required capital. It's two contracts. This is my cost basis. And you can see, because of doing a leap, it's only a 3% return, but that's fairly close to the yearly dividend. So even though it's probably not the smartest trade I've made, but it has worked out okay. It's pretty close to the dividend. I think the dividend is like 3.5 or 3.6. Next is ED. This is Con Edison, I believe. And this is the one I talked about earlier in the video. This one has been in the money almost, golly, I think it may be 2 years. And I just keep rolling it. And I seem to roll it around the same time. It's still fairly far away from expiration 5/17, and it was at 87.56. I rolled it to 8/16/24, kept it at the same strike. So I'm literally, it's usually $2 or $3 in the money, and I just keep rolling it at $85, and I bring in some pretty good premium. So over the last year, I brought in $1,225 with it. And for this trade, I brought in $257. This is the cost basis, $10,671. So that's what my cost basis is. And it turns out to be like a 5% return on a yearly basis, which more than doubles the dividend. I believe their dividend is like 4.6 or 4.7. And here, one thing to make out, you could see vertical put credit spread, vertical put credit spread. So I did 3 vertical put credit spreads. Now I've done 2 covered calls. And then next I did square, and I actually rolled it. This is a cash secured put. So again, 3 different strategies: a spread, a covered call, and then a cash secured put. So a little bit of different strategies. And the market, I believe, was up and down as I was making these trades. But I rolled, this was expiring March 15th at $65. It was $66.76, and I rolled it out, same strike, kept it at 65. Actually, I don't mind, well, like I said before, with any of these, owning any of these, but that's why I kept it at 65. It's, in a way, I do want it to be assigned to me, because I think long-term Square really has some great opportunities to grow. But I rolled it out to May 17th, which is, I think it's like 93, 94 days. And I brought in a lot of premium, $449, almost $450. And the cost of capital, the capital basis is $13,050. But even with such a high required capital, it's still a 14% yearly return when you adjust on a yearly basis. And you can see the equation up here. So it's the premium divided by required capital, and then adjusted 365 divided by 91. So it ended up being a good trade. And so, like I said, I already own a couple of hundred shares, but I wouldn't mind owning a couple of hundred more of Square. We're actually using Square for my son's business. And he shared with me something today that kind of blew my mind. So he's got one of the payment processing machines, and the machine needed an update, and he was able to take the card on his phone and actually tap the card to his phone and could run it through Square, which is surprising to me. And their software is really good. Right now we have the free account, but we may look at actually, upgrading to the more expensive plan. So next is Twilio. This is one that's kind of been hit hard. I I think they made earnings, but then their projections for the rest of the year were a lot lower. So they've gotten hammered recently. So this may be the exception to what I've said before. I'm not 100% sure I do want to own them, partially because when I looked at their projections and I looked at their product line, I wasn't as sold on it as Square or even PayPal, or some of the other companies that I like to trade in. So I decided to roll it to give myself more time. So it was 65. It had dropped to 58. So it also hit that, what I call my 10% rule. And that's where if it's more than 10% in the money, which this is, it's 58. So it's like 10 or 12% in the money. Then I typically try to manage it. You might be wondering why, but I reviewed most of my trades over the last couple of years, and I found for early assignment, even more important than how close you were to expiration was how deep you were in the money. And typically, if it wasn't more than 10% of the money, the chance of being assigned early was pretty slim. So I decided to lower the strike a bit. I rolled it out to 621. So I did go a little farther out than I typically do. I only brought in $67, again, because the stock had dropped so much. Now I believe it's right around 57 now. It did drop another dollar, maybe $1.50. And I believe I forgot to put all the premium in here, but I think I brought in about $400 in premium. So if I pick it up at 62.50 minus, another, I believe this is only one contract. Let's look back. Yeah, one contract. So I would end up owning it at like 58.50, which isn't bad. So I'm still digging deeper, trying to figure out exactly what I want to do with it. And the cost of capital here is 61.83, which would probably, like I said, I probably need to lower that a little bit. But the $67 for this time period, it's like a 3% yearly return. And then the weekly total was 2,033, which I believe this may be my highest week ever. If it's not my highest week ever, it's right there, either the first, second, or third, or something along those lines. So again, the big point is each trade was a little bit different. I had covered calls, cash secured puts. In some cases, I had one contract. Other cases, I had two contracts. And you can see I typically like to use fewer contracts. I did do a little bit more with Palantir because at the time it was fairly inexpensive. So if I have a stock that's under $20, sometimes I'll do 3 to 4 contracts versus the 1 or 2. And I'm playing with the idea of, when I can look at these returns, if I have a really good return, because I can calculate these before I actually put the trade through, that maybe in the instances where I have such good returns, maybe I should do more contracts and get more bang for the buck and do fewer contracts in the instances where the returns aren't that good. That's something I'm playing with. So thank you for joining me as always. If you want to leave a comment, you have a question to why I did something, I typically will answer most, if not all, of my comments. Sometimes I get back behind a day or two. I've noticed I've gotten a lot more comments recently. So leave a comment and I'll try to get back as quickly as possible. And as always, thank you for joining me, and I look forward to seeing you next time.